We've just had the French PMIs out, and manufacturing down to 43.6, services down to 42.7, and the composite obviously lower too. All down in a month, all lower than expected. What's your reaction?
Clearly a major concern. I mean, it's worth remembering that the PMIs have overstated the extent of the French weakness in the past couple of quarters, so I wouldn't necessarily take the PMIs at face value, but nonetheless, very much consistent with the French economy probably heading into recession in the first quarter. And from a euro area perspective, that's clearly a major concern that the second largest economy is probably going into recession.
Well, I'm just going to ask, is France, in your eyes, is it still core, or can we say is it core no more?
No, I still think it's core. I think it's got relatively strong fundamentals, but there's no doubt that there are major structural challenges, and cyclically it's in a very weak position. I think when we get the latest Commission forecast tomorrow, we'll see a significant downgrade, and the French government's forecast for growth of 0.8% this year looks ever more optimistic in our view.
Indeed, and of course we've got French bond auctions later today. They're selling 10 billion euros. I wonder how investors will shop for that. Let's move on to Germany. The manufacturing PMI expected to expand over 50 for the first time in a year. If Germany does start growing again, is it strong enough, is it big enough to be able to carry the Eurozone on its back all by itself?
No, not by itself, it's not. I mean, let's be clear that Germany, in terms of its domestic fundamentals, is very strong. It's got a strong labour market, it's got a strong fiscal position. There are no major imbalances in the German economy, so it is in solid shape. But it is an export-dependent economy. It is an economy which is going to be affected by sentiment towards what's going on in the rest of Europe. And although Germany can in and of itself do a reasonable job in terms of trying to drag the euro area out of recession, if the rest of the Eurozone is in a bit of a mess, then it's not going to be strong enough in itself to engineer a recovery.
I want to ask you about these market moves that we touched on. Obviously the minutes from the Fed, pretty downbeat in the sense that it might tighten sooner than expected. If these markets do start to unravel, stocks come down, what will the effect of that be on the European recovery?
Well, we saw the first effect straight away yesterday when markets latched on to the idea that the QE3 programme might not continue indefinitely as had been expected. We saw an immediate reaction in euro-dollar. We shed a cent pretty much straight away. Now, obviously, from a European perspective, that has implications in terms of exports, in terms of inflation, and there's no doubt whatsoever that it will also have an impact in terms of fixed income markets. So there's no question at all that the policies of the ECB and the Fed are linked. They obviously are setting policy independently of each other, but they cannot operate in a bubble. They have to be mindful of what one is doing will have consequences for the other.
But of course, a lower euro is essentially pretty good for the Eurozone.
Absolutely. I mean, you look at what President Draghi said in last month's press conference. I think part of that was targeted at the strengthening of the euro. So I think first order, the ECB will be quite pleased to see the euro showing some signs of weakness.